Good afternoon, everyone. Welcome to another edition of Market Matters. My name is Todd Jones. I'm the Chief Investment Officer for Gratus Capital. Thanks for joining us today, and apologies on the confusion relating to our live Market Matters segment today. I was held up on some travel back from Florida earlier today. Had a significant flight delay and wasn't able to make it in time back to the office here for recording. So appreciate your patience. So with that, let's get started with a quick agenda. There are a few tweaks that I've made to the presentation just based off client feedback. So I just wanted to start with some of what those are, which would include a little bit more meaningful agenda. So we're going to talk about a few items relating to this newly combined economic update and investment outlook. First, a couple of slides, we'll talk about the economy and recession, and really just touch on the point that it's kind of when the recession is going to happen, not if, but that it's also likely to be a shallow recession. So more to speak about on that. Inflation, it's really setting up for a markets versus the central bank. Currently, the markets are winning that war, but we think there could be some other things to consider there. We'll also touch briefly on the interconnection with the dollar and commodities right now, because we are looking for a little bit of a paradigm shift after such a long experience with commodities being underinvested in. And then we'll just touch on each of our thoughts on each of the main asset classes, stocks, bonds, and then alternative asset strategies. And I thought there were some really good questions that were asked, so I feel like I was going to share those there. So turning to the economic update first, really interesting now that we have, as of yesterday, it was reported actually, some up-to-date data reflecting what's going on within both the services sector, which is the purple line, and the orange line, which is the manufacturing sector. Nothing really is changing with the manufacturing sector. It's clearly in a broad decline or contraction. No real surprise there, but recall that did happen just as recently as 2018 into 2019. But the services sector has remained very resilient with a big snapback in January from a very negative reading in December. And I think this does change the game a little bit. It also helps us understand why bond yields are snapping back now after having declined for most of January. And I think this is just something worth noting, but really it's a question of when, not if. The key question, though, if we understand that it's going to happen, is, well, how severe is this recession going to be? Because varying degrees of severity can bring out various degrees of impact on the economy, but also by extension, asset prices. Category 5, that would be something akin to the financial crisis or the S&L crisis that was in maybe the late 80s, where a very significant contraction in economic activity leading to some contagion in various locations that led to a broad-based sell-off across multiple asset categories. We think in category 5, just to use the hurricane analogy, is a very unlikely outcome because there's not a lot of contagion avenues that we see at the moment. And we do think that in speaking with Ken Lockhart, I was at a dinner with him 2 weeks ago, where we had this exact dialogue at an event he was at. But he and I both think that what we're likely, he's the former Atlanta Fed chairman who's since retired. Not as retired, he can actually give us his real thoughts about what he thinks. And he thinks that similar to what we've been thinking here, is that category 1 is most likely what's in front of us. And for those of us that have gone through category 1 hurricanes, they're bearable. They're nothing too significant or strenuous or stressful. And thinking about what that might look like from an economic perspective, it would be something akin to maybe the early 90s, where we had the Gulf War I recession after Saddam Hussein invaded Kuwait. Very modest impact on markets. So with that as a baseline, so modest recession is in the cards, potentially on the horizon. What's inflation look like? Because as you know, regular Market Matters listeners will know that's a big bugaboo for us. And I think there's some good news, bad news here. The good news is that if you're looking from left to right, from the start of 21 into 22, and now into 23, the picture has actually got a little bit greener as we've made our way through 21 and 22. So greener is better. It means that there's deflation or very low inflation going on in some of the various subcategories here. The problem is, though, in the core, this what they call core services area, this remains very problematic because housing inflation has been very sticky for a variety of different reasons, whether it's supply or the ability to push rents in certain areas with COVID, remote work, things of that nature. And even things like transportation or medical services still continue to have some positive inflation attached to them. So until we see this core services section, which does account for almost 60% of how CPI is calculated, until we see some decline in these core areas, it's going to be really hard to get very comfortable feeling that inflation is now on a very definitive downward trajectory down to the 2 to 3% level that the Fed thinks they can get it to at some point. And for those of you that have been watching, this 6% in year over year or rolling 12-month average inflation is really important because going back to the 1920s, the study that Capital Group ran, what they found was every time coming from a higher level of inflation down to lower, but breaching through 6 is when financial markets start to act much more favorably than if they were rising, going upward or staying elevated in inflation. So this June-July timeframe does appear to be now, based on the current trend in inflation, when we do breach that 6% level on a rolling 12-month average basis. And that does nest up nicely with our idea that the markets are likely to be fairly range-bound or choppy for the first 6 to 9 months of the year, with potentially a better outlook for equities and risk assets in the back half of 2023. So looking at currencies, we tend to not necessarily look at dollar or currencies too often, but it does bear mention because there have been some very meaningful moves in the currency markets more recently. This is a chart as of January 27th. What you can see is the dollar has been very range bound as a currency relative to other currencies for a number of years, and then recently, post-COVID, it really broke out to a new high level, intermediate term high level, and it's come off quite substantially. And the only reason we want to mention this chart is because when the dollar is rising, that tends to favor owners of dollar-denominated assets, so U.S. stocks, U.S. bonds, relative to international investors or investments. However, when that goes the other way, that dynamic where the dollar is declining versus the euro or the yen or others does tend to be an environment that favors international assets. So how is this relating to what we're doing? We are certainly now looking more attentively at international assets as a possible option, because if we can get that favorable currency headwind with a better valuation starting point, then we should consider it pretty closely or carefully as an option for our portfolios. And then finally, commodities. I did just want to mention this is a long-term view of the CRB Total Return Commodity Index, and it just basically takes all commodities weighted by their trading volume, puts them into a basket, and you can see here how commodities have evolved. So after quite a bit of deflation in commodities over the last, call it 14 years or so, since 2008. Remember, this is when oil peaked just before Beijing had the Olympics in 2008. We've been on a pretty decent downward trend in commodities, but again, COVID shook us out of that trend, and it's our belief that we're now in a probably more durable upward movement for commodity prices, whether it's because of deglobalization, where companies are reshoring their supply chains, or underinvestment in key commodities at the local level. These are all reasons to think that commodities might have a better 10 years than we had the previous 10 years. So short term, because there was such a spike, probably downward pressure on commodities at the moment, but longer term, we still think there's a nice upward bias or a tailwind for those. So that will make their way into some of our equity positions, but also potentially alternative type positions. Just looking at our investment ratings, recently not a lot has changed. Since Q4, we've had a pretty is when we did start to pivot the portfolio to have larger amounts of things like mid-cap companies within our portfolio. We made those changes towards the end of the last year, early this year. And the other, I would say, upgrade we made at that time in Q4 was to upgrade government bonds to a more attractive rating. Now that their rates are on the short side, a decent level. So think the 1-year Treasury bond is now at 4.8%. That's a pretty good starting point for high quality fixed income. And then we did maintain our developed markets international weighting at this kind of neutralish rating, but that's likely to make its way up as we consider it more heavily for our portfolios. And this is what I was talking about, looking at the starting point. So what you see here on the screen, I think I've showed this before, but I did try to make it a bit more clear as far as takeaways. What you're seeing here is the 1231 valuation. This is the PE multiple for each of these asset categories, U.S. stocks, international stocks, emerging markets, S&P 500. What you see here below it, right below it, is the 20-year average forward PE ratio for each of these categories. And then you can see here the premium or discount that we're trading at 1231. Now, I realize some of this has changed, but actually it's changed in such a way that makes this chart only more exacerbated to some degree, because S&P now trades as of to February 7th, right around 18 times earnings, so a bit higher than it was here on 1231, which makes the relative attractiveness a little bit less attractive. Emerging markets, similar story. That hasn't changed a whole lot because emerging markets haven't changed as much as the S&P has. International developed markets, this is the EFA index. European stocks make up the majority of this, but this does include things like Australia and Japan in small parts. But you can see here the EFA index, the broad international index, not only trades at a much lower forward valuation and starting point, but the dividend yields and other metrics like price to book or price to sales are much lower than the S&P 500. So again, this is why our attention is now oriented on some more attractive opportunities in the equity markets that aren't necessarily S&P focused. And then interestingly, this has been a big question mark for us for a while, but we've been paying attention to it, is that mid-cap companies are also trading at a pretty decent discount to their long-term multiple. And you can see they're trading at a pretty sizable multiple difference from the S&P as well. So that, good starting point. Also nice discount to their forward 20-year average PE. So we think this is going to be a really attractive and meaningful position for us to scale up over time. I did show this on the 2 minutes with Todd one week in January, so I thought I would share it again. But this is a great chart just signaling, what sentiment is doing in markets, and how if you look at, try to identify those longer term trends around the mean, you can have, again, a pretty good starting point. So what is this chart telling you here? Well, the sentiment chart is just polls consumer sentiments and says you have a positive outlook or a negative outlook for the next 12 months, not necessarily relating to the stock market. It's just, are you positive or negative? And when everyone's telling these surveyors they're negative, that tends to be a pretty good time to buy stocks. And you can see here over history, back into the 1970s, every time this sentiment index has gotten below this 60 survey level, which it was for a number of months last year and certainly in December, the forward average return for those for the next 12 months is a pretty meaningful, 24 or 25%, which is the exact opposite of when you hit sentiment peaks. Your average return for the next 12 months is 4%, even negative in some cases. So not that this is a silver bullet, but I think it does, again, nest up with our idea that, yes, the current conditions are a bit dicey, maybe a little bit choppy for some segments of the economy. Recession is likely on the horizon, but that's already being priced into the market at the moment. And when people are telling you they're very negative on the economy and their situation, that tends to be a max pessimism. So we're pretty confident that what we saw last quarter, we're not going to necessarily have a substantial leg lower from what we saw, in Q3 of last year. This is just a chart I think does describe why we think European equities in particular are attractive now versus S&P. And it relates to margins, profit margins, and earnings estimates. So generally, you want to see stocks perform well at the index level when both margins are rising as well as earnings estimates are rising. And that's just a general heuristic, but it's a simple one to be mindful of, because right now, what you're seeing is EBITDA margins, and for the S&P 500 have actually started to come down a little bit. whereas international EBITDA margins are rising and actually eclipsing US for the first time in a long time. As our earnings estimates for the US companies are starting to soften up, we're starting to see year-over-year declines in earnings in the S&P coming through for Q1 quarter, year over year. Whereas in European companies, they're actually rising. So when you have these types of deltas to keep it, be mindful of, then there can be some opportunities to look outside of our borders for stock opportunities, which again, we are very carefully right now. This is just the one slide I wanted to share on what the bond market is giving us as opportunities. And again, as you all know, if we have a recession in front of us, we've been very vocal about the fact we don't want to be taking on a lot of what they call credit risk through things like high yield bonds or some less liquid parts of the fixed income market. And I think there's good reason to stay high quality and very liquid, because you can see here, this is a chart of the yield curve that shows you what the yield curve yields are at various maturities over time. And the most recent indication, this orange line, shows you that the 1 month T-bill is yielding 4.6%. This is as of February 6th. The 6 month T-bill is yielding, call it a 4.8. 1 year is almost at 5. And then it gets lower, interestingly, as you go out past 1 year. It starts to get into a lower level, which is interesting. So our strategy right now is to stay on the shorter end as we see opportunities. So we're effectively doing that through having very short duration, ultra short bond ETFs, or if we're purchasing individual bonds, having maturities that are generally no longer than, call it 2 to 3 years right now. And in some cases, 2 years and less if we're buying treasuries. The big difference in our strategy, I think, or our thoughts versus maybe what other competitors are thinking or the markets, is that, while we do want to celebrate the fact that inflation is coming down, I mean, I'm sure tonight at the State of the Union, we'll all hear about how inflation has come off dramatically from President Biden. And while he's right that it's come off from its peak, we still think there's a lot of wood to chop to get down to that target level of 3% the Fed has outlined as their go forward rate. And this chart just helps demonstrate why, because the purple dots here are the summary expectations of what the Federal Reserve governors think the federal funds rate will be at. Remember, that's the very short-term rate that the Fed can adjust upward or downward to help ease monetary conditions or restrict monetary conditions to rein in speculation and the like. And what you can see is here in 2023 at the end of the year and 2024, there's a big difference between what the market thinks the Fed funds rate is going to be and what the Fed thinks it's going to be. So just to orient you here, the average Fed governor thinks that the Fed funds rate is going to be a little bit above 5 at the end of 2023. The market, however, thinks that the Fed funds rate is going to be at 3.5, maybe 4. In 24, it's even bigger chasm. So the market thinks that the Fed funds rate is going to be at 2.5, which is really, I think, aggressive from where we are today. And the Fed thinks that we're going to be on average right around this 4% line. So about a 1.5 percentage point difference. And my point in showing this chart is that someone's going to be wrong. Is it going to be the market coming up to where the Fed thinks they need to be, or is it going to be the Fed coming down to where the market is at the moment? And I think if it's the latter, then that has a way of risking Fed credibility. But I think it's what we're saying here is it's likely the former, where the market has to adjust up at least probably a little bit to where the Fed is right now, because Chair Powell has been very clear in his conferences that he's been giving more recently that there is likely more interest rate hikes to do and potentially keep it at the Fed funds rate at a higher level than most people think for a little bit longer to make sure inflation doesn't come back. And then the final slide I wanted to share relating to investment opportunities is this chart here. I'm using a bee analogy because this bee analogy really works with what this chart tries to outline. So what you see is here a broad cross section of alternative strategies, some of which we use, some of which we don't. But the key insight here is that when cash rates are low, meaning interest rates are low, as we came out of, for the last 10 plus years, that the average return for these hedge fund strategies all tends to coalesce around a certain level. because there's not a lot of differentiation or dispersion between assets. 6 to 7% is the average return across these. However, when interest rates start to rise and cash is above 2%, so the temperature starts to heat up a little bit, just like bees, these strategies get more active, and more importantly, the dispersion between these strategies gets much wider. So you can see the difference between the average hedge fund index versus the global macro index, 4 percentage points or so, versus when things are colder or cash rates are low, only 30 basis points or so. And so the reason we just wanted to mention that is because we do see opportunities continuing to be pretty attractive within alternative strategies. That is an area that we have as an emphasis as a fixed income replacement. So we think that there's still lots of things to do in that side of the portfolio. And just some key takeaways here. I won't highlight all these, but I do think it's important maybe to highlight two on this page. One is that we've mentioned that interest rates have been rising on the short end more recently. And, at some point, interest rates on treasuries or high quality corporate bonds or muni bonds become really attractive. And so we have to consider the fact that maybe at some point we start slicing off some of our alternative strategy, or even adjusting asset allocations for some more conservative clients to be more heavily weighted to bonds. And we think once that level on the yields gets somewhere between 5.25 to 5.5, was when we would make that potential shift in asset allocation for some clients that tend to be more conservative or collapsing part of our alternative sleeve. The other insight I just wanted to highlight here would be, going back to the dollar and inflation. The game plan is if the dollar is declining, that would likely mean that inflation would be potentially still an issue, because of, if the dollar is declining in relative terms, that means that could be acting as an inflationary impulse. But the game plan there is to be, again, more heavy into areas like international companies, but also value stocks versus growth stocks, and even things like mid-cap stocks do a better job at accounting for inflation adjustments than maybe large cap companies do the S&P for a variety of reasons. One common theme that does come up that I did want to address would be, concerns about the U.S. budget deficit, overall level of debt. How are we addressing this in portfolios? Well, this is a very long-term issue that is nothing new by any stretch, and it's the whole cruise liner analogy that even if you turn the rudder a little bit on a cruise liner, it still takes a long time for that cruise liner to actually adjust course. And that's kind of the idea that we're implementing here, is that we do have certain assets or strategies that would work in a debt super cycle, if you will, or a debt issue cycle. But we could also add things we haven't previously looked at for a long time, things like gold that tend to preserve purchasing power. And I thought that was, a question we haven't had in a while, but I think as we approach 2024, that is an election year, as much of us don't want to admit that. In 2024 will come some strong rhetoric about the way forward and budget deficits and things of that nature. So we'll certainly be bringing on more guest speakers. Mike Townsend is one of them that I've got on the calendar, I think, for November of this year. So look forward to that. But we will be addressing this with, more informational sessions like we're on Market Matters, but also guest speakers as well too. But for right now, we're incrementally adjusting our portfolios. And again, one way to account for a debt issue would be to stay in very short-term debt, like what we're doing right now. The other question that I can't really answer a lot about private strategies. Please feel free to reach out to one of our advisors on that. We can provide you more information on our private strategies. I can't do that here in this public forum though. And I think we touched a little bit about the international holdings. I did just want to mention, again, we're looking primarily at European exposure here. We're not necessarily looking at emerging markets or fringe markets, because those carry very unique risk characterizations or risks that we think, like Chinese equities, for example, have a political premium or a discount that should be baked into those prices that maybe isn't accurately reflecting in those stocks right now. So we're going to be focusing much of our international stock efforts on European companies. Well, I think that's about all I had prepared for this discussion today. And any content you would like to see here in the future, please shoot me an email directly when the replay comes out, or speak to your advisor. And we'll talk to you again sometime soon. Thanks, everybody.